Cashbuild shares fell over 6% after it slashed its interim dividend by nearly a third. The building materials retailer says in its half-year results that was reflective of the current tough economic and trading environment. Revenue declined 4.1%, and in terms of cash flow, net cash generated from operating activities more than doubled to 133.1 million rand. However, for more, we are joined by Werner de Jager, who is the CEO of Cashbuild. Werner, thank you so much for your time. I mean, looking at the interim figures, certainly a reflection of the tough trading conditions. However, for the benefit of our viewers, give us some color in terms of the 6 months that was for Cashbuild.
Yes, it's certainly been one of the more tougher trading times for us. It's a number that's reflected 5.6 billion turnover, so it's back to levels that we've seen pre the two COVID boom years that we had. And we also had to fight for our market share, and we had to reduce some prices somewhere, and our gross margin was slightly lower. Costs were up, and that all related down to bottom line, which was down,
right,
as you mentioned.
So, I mean, given this environment of rising inflation as well as rising interest rates, what sense are you getting about the consumer, especially your target market? What trends are you picking up about their spending patterns?
Yeah, it's clear that that there's not a lot of spare cash left to invest in homes at the moment, and the type of projects that people get into is the smaller type projects. You know, tiling your floor, or painting, or making a ceiling look better, putting cornices in, because those products were the only products in 6 months that actually saw a slight increase in sales, whilst your structural type materials that you build with, your bricks and cement and door frames and window frames were down on the prior 6 months. So it's a clear indication that there's not big projects on the go. People are just doing minor alterations or minor improvements to their houses.
If you look at some of the companies that have reported results or published their trading statements, one of the things that becomes notable is the issue of load shedding and the increase in costs that come with that. And you mentioned in your result presentation that your operations are less affected by load shedding, and that's because of the generators, battery power, or solar systems. From a cost point of view, are you able to quantify what all of that is going to cost in order for you to keep operations up and running for customers?
Yes, it's the installation of generators we've had for a couple of years already. So, but it's costing us a lot of money extra in terms of running the diesel and paying the diesel bill. So, again, we're not like I said, we're not a big user of electricity. So we're spending about R1 million a month extra on diesel at this stage to make sure that we can trade during load shedding.
I'm curious, when it comes to, this background that we've been describing for the past couple of minutes, what does that do for you in terms of store expansion, relocation and refurbishment? I mean, how much do you then plan on spending to be able to do all of those things? Or are you a little bit conservative with cash?
So, our approach has always been fairly conservative. So we've refurbished 12 stores this half year, Cashbuild stores and 2 P&L stores. So we're continuing with that process because we know that you have to invest in your business. If you leave it for too long, it'll catch you later on. And in terms of new stores, we did open the 3 for this half year that's gone by, and there's another 2 that will open in the next 6 months. We're still looking for opportunities, but there's much less projects on the go in terms of new shopping center developments that we see out in the market.
In terms of those opportunities, and I'm sure from an earnings growth perspective, you'd want to look for opportunities in order to gain market share or perhaps even offer new products. What's within your control in order for you to expand in an environment like this that's so tough?
We must make sure that we execute well and that we focus on what we can control, as you say. We must make sure that our pricing remains competitive, because that in a market like this, consumers are looking for the best deals. So we must make sure that we are very competitive on our pricing. And also our customer service is good. And then last but not least, we must make sure that we always have stock on the shelves. If people do want to come and buy something, it's a travesty if you don't have the product on stock for them to buy. So that's also a key focus for this period we're in.
In this period that is so uncertain, are there any green shoots that you're seeing in the sector that you're operating in?
I mean, it's fairly widespread. We look at our business by country, by province and region, and all of the regions are experiencing exactly the same. And with the exception of maybe Malawi, where we've seen some very good trading coming from, which is an indication that the broader economy is under pressure, and it's not something that's happening in a specific store or in a specific region. So it's one of those things that we keep on focusing
on that note, then,
sure
with management expecting tough
right
trading conditions to continue, what will you and the rest of the team be focusing on?
We are looking at various alternatives to see if we can expand our income from different other streams that we're not currently getting. We're investigating things we've never even considered before. So we will make sure that we focus on getting those on track.
Werner, thank you so much for your time. That is Werner de Jager, who is the CEO of Cashbuild. However, moving on to the markets picture now, Asian stocks rebounded from a 2-month low as data showing China's manufacturing activity in February expanded at the fastest pace in more than a decade. That cheered investors, offsetting fears over rising interest rates. We saw Chinese stocks also receiving a boost. Hong Kong's Hang Seng Index climbing 2.6%, while the Hang Seng Tech Index was up 4%. Locally, department store chain Woolworths reported a 75.1% jump in mid-year earnings, but they warned of a slower growth come the second half, and that's been impacted by the country's power crisis in South Africa. And in the part of the business that houses Woolworths' upmarket grocery, fashion, beauty and home businesses, the retailer grappled with crippling rolling power outages, which have reduced its domestic adjusted operating profit by an estimated 15 million rand per month. However, to give us a little bit more perspective, we are joined by Chantal Marks from F&B Wealth and Investment. Chantal, thank you so much for your time. So let's get into the global market sentiment and what you believe is keeping investors on their toes, so to speak.
There's actually a lot keeping investors on their toes, but I think that the overarching theme really remains interest rates, inflation, and now we've added China to the mix as well. The China reopening, will it be enough to actually have an impact on the global growth outlook, which we know isn't great for 2023? And I think that a combination of those things is really what is driving the volatility as well, because data is pointing us into different directions. We have differing views from different committee members at different central banks, and market participants are unsure who to believe, what to believe, and what is priced in and what is yet to be priced in.
So when you look back at the month of Feb, is the overarching theme inflation and interest rates, or is it something else?
I think it's most certainly inflation and interest rates, and what that trajectory is going to look like going forward. What we did see in Feb as well is markets taking a bit of a breather and saying, okay, January's been really strong. Everyone was super excited about China reopening and what that will mean for markets, for global demand, and the rest. But forgetting that inflation is still quite high, inflation is still quite sticky, the US economy is still quite strong, and we saw market participants pause and look towards what they're pricing in from a Fed perspective. And it seemed as if the market was too optimistic around when the Fed would pause their rate hikes and more importantly, when they will actually start cutting.
So let's talk about Woolworths. They released their results earlier today. Any standouts for you or concerns?
So I think the funny thing about this set of results is everything that was wrong with the business is now right with the business. So a year or two ago, we would have talked about how fashion, beauty and home was such a disappointment. Australia was a drag on the performance. Dow Jones is horrible. Now they're selling Dow Jones. South African fashion, beauty and home is doing very well. And Country Road also had a very strong performance. And now we're worried about the food business. And the food business has been the big accelerant for Woolworths and their top line growth over the last decade or so. We're seeing them losing market share. I suspect to Checkers really stepping up their game in that space, and also having severe strain on their margins because they're investing in price to become more competitive, or to at least stay competitive. And they also have to compete with wastage because of the impact of load shedding and, of course, the cost of running throughout the load shedding period.
The one thing that has been quite interesting is getting analysts' commentary on what they think of valuations, at least company valuations, in an environment like this. When you look at that, are you satisfied with what you're seeing, or is it a little bit too expensive?
So I think if we look at the local market specifically and SA Inc. stocks, so we're not looking at the big deal listeds, I think that valuations are still at reasonable levels, and there are actually pockets of really good value within the South African equity market. When it comes to the international stocks, it does seem as if some of them are running quite hot. I think notably Richemont, a lot of rumors around corporate action there. Not the first time that it's happened though. So these stocks look a little bit on the expensive side. And if we look at the US equity market, it does seem as if the market is more on the expensive side if you consider that a near-term earnings recession is anticipated. So it's a mixed outlook at the moment, but SA Inc. I think is fine.
So with that mixed outlook, is there an argument to be made for certain pockets of equities, whether it is somebody chasing the sustainable dividend-paying companies or somebody looking at perhaps more value companies?
So I think when you are investing against the backdrop of a lot of uncertainty and a lot of volatility, it really is a case of looking at the stocks specifically. I had a quick look at how the different factors performed over the month of February, and there was almost no factor, so that is risk, quality, growth, value, that outperformed the market during this month. Momentum even was weak, and that is actually a factor that performs quite well in South Africa. So what this does tell me is that it's important to look at stock specifics. So if you do have a value bias, sure, look at value stocks, but don't buy all of them. Go into the details, scratch around, and make sure that what you're buying isn't a value trap.
On that note then, Chantal, thank you so much for your time. That is Chantal Marx from FNB Wealth and Investment. And just on that, we were talking about Woolworths having to spend about 15 million rand per month. And that has basically on the back of the crippling rolling power outages having an effect on their operating profit. That share price down 2.2%. Cashbuild, who we had earlier on, share price down 5.1%. However, that is it from me. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.